This question relates to the preparation of financial statements for limited companies. This is question number 13, taken from 2021 Paper 1 exam. The bookkeeper of Crofty Limited has provided the following information. So you can see we have two financial years ending 30 April 2020 and 30 April 2021. We are given the information for taxation owed, which is a liability. We are given the information for 8% debenture and 6% debenture. Now, debentures are loans that are given to a company. We are also given some extra information regarding the draft profit from operations was £45,586, and this profit does not include a return outwards of £1,030 and prepaid expense at the end of the year of £670. We have also other information relevant to taxation that has been paid during the year, and also information relating to the new debenture that was taken out on 1 August 2020. The requirement of this question is to prepare an extract of the income statement for Crofty Limited for the year ended 30 April 2021. So on the right hand side of the screen, I've done some workings, which are what we will be going through first, and then you will be using these workings to prepare the final extract of the income statement. So we're going to start with the taxation owed account. So taxation owed refers to the tax obligations for Crofty Limited. In other words, this is also known as the tax liability. So this is a liability account. So what we are doing here is preparing a T account or a ledger account for taxation owed. And because we understand the taxation owed refers to liability, and given that we know that liabilities always have an opening balance on the credit side of the T account, we are using the opening balance for taxation owed, which is £2,561, and showing it on the credit side of the T account. Now, where did we get this £2,561 from? So if you look into the question, we know the balance at end of previous financial year, which is 30 April 2020, and that was £2,561 for taxation owed. When this balance would have been carried forward to the new financial year, starting 1 May 2020, then this would become the opening balance. And the opening balance is shown here on the credit side within the T account, as we have already figured out, which means that the closing balance needs to be on the debit side, which is the amount given at 30 April 2021 for taxation owed, and that is £3,102. During the year, we know that we have paid taxation, and that was £8,863. So if a company has paid taxes to the government, obviously this refers to a reduction in the balance for the bank account that the company has, because the company will be paying this amount to the government through the funds available in the bank account. So within the taxation owed T account, you can see that I've included bank on the debit side of £8,863. Now, what is the logic of including it on the debit side? Think about it. When the company is paying taxes to the government, there is a reduction in liability. As we already understand that liabilities by default are credit, and anything that reflects an increase in liabilities are always shown on the credit side. But because we have paid for taxes, which means now there is a reduction in the liability. So therefore, if there is a reduction in the liability, we have to debit it. So that is what we have done here. So you can ignore the details that we have highlighted here in yellow. So I'll explain you how we have got that. So what we did, once we had the closing balance and the funds that we have paid for taxes on the debit side, we found the total for these two numbers, which gave us £11,965. That must be the total on the credit side as well, so that both sides equal. And if we subtract the opening balance of £2,561, we're left with £9,404, which is what goes to the income statement, and this is what we refer to as a tax expense. So this is the exact tax expense for the financial year ending 30 April 2021, which is £9,404. Also think about this from another perspective. you see how this amount for tax expense is shown on the credit side of the taxation liability account. Why is this shown on the credit side? This is because if we owe more taxes to the government, then that's going to increase our liability. And that is why, because this tax expense of £9,404 for the year would have increased our liability, or the liability that we have for taxes to the government, we must include it on the credit side to reflect that increase in the liability. Okay, so this is what we will be using when we want to calculate the final profit, the tax expense of £9,404. So let's move on to the other set of workings. So we know that we have two types of loans here. So one of them is the 8% debenture, and then the other one is the 6% debenture. Now the 8% debenture loan was also there in the previous financial year ending 30 April 2020, and it's still here in the current financial year ending 30 April 2021. So how can I validate this? If you check the figures for 8% debenture, you will see that the balance at 30 April 2020 is £60,000, and so is the balance at 30 April 2021, which is also £60,000, which means this is a long-term liability and the business still hasn't paid this off, which means the 8%, the interest rate, is still applicable on this loan. So how do we calculate the interest expense on this 8% debenture? So we apply 8% simply on 6,000. So we do 8% multiplied by £60,000, which is the principal of the loan that was taken. And then we get an interest expense of £4,800 for this loan. We also have another category of loan, which is 6% debenture. And you will see that this loan didn't exist at 30 April 2020, but it does exist at 30 April 2021, which is a clear indication of this loan being taken in the current financial year. And this is also validated by the additional information number 3, which says that the loan was taken out on 1 August 2020. So 1 August 2020 would be falling in the current financial year, which starts on 1 May 2020 and ends on 30 April 2021. Okay, so first of all, if I want to find the interest expense on the 6% debenture, I'm going to use 6% and multiply it with £20,000. All right, but when you do that, that's what you get on an annual basis. 6% simply multiplied on £20,000 would give you the interest expense for this debenture on an annual basis, or the interest expense for 12 months. But if you remember, the question says that the loan was taken out at 1 August 2020. So from 1 August 2020 until the end of the current financial year at 30 April 2021, how many months have passed? So we have August, we have September, we have October, November, December, and then we have January, February, March, and April. So that's 9 months in total. So 9 months in total. So that is why we are apportioning this further by multiplying it with 9 over 12, which adjusts for the fact that out of the 12 months in a year, we have used this debenture for 9 months only, and that is how the interest expense is adjusted. So once you do this calculation, you should arrive at £900 being the interest expense on the 6% debenture for the current financial year. Then you find the total interest expense. You just add £4,800 that you got from the 8% debenture, and then add it with the £900 that you got from the 6% debenture, and you get a total interest expense of £5,700, which is what we're going to be showing in the income statement. Now we're going to take care of the first additional information that we are given. It says that the draft profit from operations was £45,586. So the draft profit here refers to the profit that isn't official yet, or it's unpublished to the shareholders. So we start with the draft profit, and then it says that this profit does not include a return outwards of £1,030 and a prepaid expense of £670. So let's take care of these two items. So we start with the profit from operations of £45,586, and then we are adding return outwards of £1,030. Now let's have a discussion here why we are adding this, okay? So I'm going to show you some extra stuff here. First of all, within the income statement, where is return outwards included generally? In the cost of goods sold calculation. So here I have written cost of goods sold, which is COGS for short. So cost of goods sold can be calculated by taking the opening inventory, then adding purchases, which is plus P, and then subtracting any return outwards. Returns that we are sending out to our suppliers, and then we subtract any closing inventory. So this is the formula for finding the cost of goods sold, okay? Now, when it comes to the return outwards, what's happening here is that we actually had a return outwards of £1,030 for the year, but we didn't include it in our calculations before. So if we were to include £1,030 for return outwards, what would that do? So that would mean we will be subtracting more because return outwards is being subtracted within the formula for cost of goods sold. So if we are subtracting more for return outwards, that automatically decreases the value that we have for cost of goods sold. Right. So if cost of goods sold goes down, what's going to happen? We know that sales minus cost of goods sold equal to gross profit. So if the cost goes down, then our gross profit should go up. Right. So let me make a note here for you. So if the cost of goods sold goes down, then gross profit should go up because now you have less cost to deduct from sales. And if gross profit goes up, then the net profit or the final profit for the year should also go up. All right. So let me go through this quickly again with you. So we had return outwards of £1,030 that wasn't included before in the draft profit. If we are to include this now, what's going to happen? Return outward goes into the calculation for cost of goods sold. So as you can see with the formula that I have written here, cost of goods sold equal to opening inventory, add purchases, minus return outwards, and minus closing inventory. So if we include an extra 1,030 for return outwards, it means that we are subtracting more. And that results in a reduction in the value for cost of goods sold. We know that sales minus cost of goods sold equal to gross profit. And if cost of goods sold goes down, then gross profit should go up. And if the gross profit goes up, then the net profit or the final profit for the year should also go up. All right? And that is the main reason behind why we are adding return outwards to the draft profit that we are given. So that's why we are adding £1,030 to the profit from operations. Let's look into the prepaid expenses. So we know that we have prepaid expenses at end of year of £670. All right, so if we have prepaid expenses, prepaid expense refers to a current asset. Prepaid expense refers to payment made in advance for an expense that will be consumed in the next financial year, which means the amount of £670 is a current asset to Crofty, which Crofty will be consuming in the next financial year. So within the draft profit from operations that we are given, this prepaid expense was included as part of the total expenses, which is wrong. So we have to separate this from the profit calculation, okay? So let me show you what's going to happen here. So we understand that prepaid expense is a current asset. So if we were to remove the prepaid expense from the total expenses, then our total expenses should go down. So total expenses goes down. So if total expenses goes down, then again, profit or net profit should go up. Right. So if net profit goes up, then we will be adding the prepaid expenses of £670 to the draft profit from operations to reflect the fact that if we are correcting this, this is going to increase the profit. Okay. So that results in a final profit from operations of £47,286. Now that we have all the numbers, so we can use this profit from operations that we have calculated as the first step to preparing the income statement extract. So on the left-hand side of the screen, you will see profit from operations of included £47,286. So profit from operations simply stands for the profit that we have calculated from sales and all other expenses such as cost of goods sold but excluding finance expenses such as interest expense. So profit from operations is £47,026. Then we subtract any financing expense, which is the interest expense in this case, and that is £5,700. You remember we have calculated this by finding the value for interest for the 8% debenture and then adding it with the interest expense for the 6% debenture. And that gives us a profit before tax of £41,586. Then we simply subtract the tax expense that we have derived at the very beginning, which is £9,404. You can keep this in bracket to reflect a reduction. And then you get the final profit for the year of £32,182.